So there we have it. Rebecca Teltscher explained to us that utilities look like a decent bet right now. And sure enough, they've been outperforming the TSX. She sticks with us now for a second block. It's great to have you give us this time. What about gold? Do you always like to have a bit of gold in portfolios?
Yeah, so it's a nice diversifier. So in our portfolio, we have a small, it was a 2.5% weighting, but it's clearly done very well. So it's a little bit higher now in one of the gold producers. So we own Agnico Eagle Mines. And the reason we own that one is just it's, less international risk. We've seen what happens, with First Quantum and some of that, exposure when you have mines in certain jurisdictions that are not investor friendly. Most of the mines for Agnico Eagle are in, Canada or very investor friendly jurisdictions. Has a dividend yield lower than it was, let's just say, a year ago, because it's done so well.
Less than 2%. Sorry,
It was almost 2.5%, a while ago, but now, it's done very well. It's been hard for buying it for new clients that are coming in, just because it's performed so well. But again, it just goes to show when markets get scared, as we've seen this year, there is that flow into gold. And it's interesting because we've seen that flow into gold, but that flow into crypto as well. It makes me think, if crypto wasn't around, would gold even be higher than what it is now? So, we're seeing it's over $3,000 an ounce. If crypto wasn't there as a second option to be out of the market and into something that's considered a safe haven or not not linked to the markets, would gold even be higher? Probably.
Crypto often seems to perform in line with tech stocks. It's not a perfect correlation, but it looks like the same constituency of investors may be interested.
Yeah, it fits the boxes in terms of speculative and high risk, high reward. I think the past 2 years have shown the markets that you can take very high risks and get rewarded for it. And I think we're seeing 2025 so far this year as a market that's coming back to reality, and that's not necessarily the case. So I've always said, like last year, the market was very disconnected from the economy. So you had the markets that were really taking on a high amount of risk, and it was causing valuations to get unsustainably higher, especially for the Mag 7s. Some of these technology stocks are trading at 100 times earnings. They don't pay any dividends. Really speculative. And it caused the entire market to get speculative. And it's interesting because since the threat of tariffs and since the threat of the economy is now coming into question, you would think the Canadian market would be more at risk because, threat of tariffs will directly impact Canada before it impacts the U.S. There is, of course, an impact to the U.S., but it's more a second derivative. But you're seeing the NASDAQ being hit the hardest. Why? In my opinion, it's because valuations were overblown. The market, the NASDAQ particularly, was a speculative market. And so even though the threat of tariffs impacts Canada more, the Canadian market was actually very reasonably priced in terms of a multiple. I think the NASDAQ was trading at double the multiple of the TSX. And so you're seeing these riskier stocks that are trading at 50 times earnings getting impacted the hardest, because now that growth or that valuation that was priced to perfection is now coming into question.
What about NVIDIA? Are you tempted there? We know that they've had massive growth from the build-out of data centers, but competition will arrive, there's no doubt.
Absolutely not tempted. And I have to be honest, I feel like we were one of the only ones that didn't own it, especially for the past 2-3 years, as it's done exceptionally well. I'm sitting here on the sidelines and I'm scratching my head as to how it continues to do well. At the end of the day, our portfolio focuses on critical infrastructure. So revenues that are backed by the infrastructure that is often irreplaceable, like a utility. No new entrant is going to come into Ontario and build new new utility towers. Same thing with the telcos. NVIDIA, they don't actually manufacture their own chips. They're really just they're 100% intellectual property.
It's interesting. It's a virtual company in that sense.
Absolutely. So I think to myself, what happens if a new entrant, comes in, or not even an existing entrant, and makes a chip that's more powerful? What happens to the value in NVIDIA? Same thing when, China and DeepSeek, came in that weekend that they announced, that they were using regular chips that they had on hand. What does that do to the value of NVIDIA? How important is NVIDIA to the growth of AI if you can use less powerful chips to run a similar or comparable platform? So in my opinion, if you don't actually have the infrastructure or the manufacturing that's backing your revenues can disappear, in the blink of an eye. And the same thing with, the fact that they do not have a sustainable or a substantial dividend. Your earnings, like your shareholders, are only relying on capital appreciation for their total return. They're not collecting a dividend, consistently on a quarterly basis to help offset the fluctuations that can happen with the share price.
And we know that around the world, programmers are trying to find ways to build AI using less hardware. And I mean, that's been the story of the computing industry, using less and less hardware.
Absolutely. I mean, the chips are expensive. They're in high demand. And also the amount of power that's used to run these chips on a 24-hour basis. So the chips itself use a lot of power, and the environment of these data centers also use a lot of power, because they have to have consistent energy sources, be in a very stable environment with a set temperature. We're not even getting into the type of environment needed to produce the chips, in Taiwan, for example, the environment that's needed to produce these chips as well, all, using a ton of power. And that's why we don't know who's going to be the winner in the next 5 to 10 years in terms of the chip wars. But what we do know is that there's a need for more power and energy demand across the world. And a lot of that energy is going to come from cleaner energy sources, as Taiwan, for example, most of its energy is run through, coal or oil. There's going to be a shift to, renewables, natural gas, possibly nuclear. And so our portfolio is kind of betting on the increase in power demand to help fuel the growth, but we don't care who the winner is as long as more power is being utilized.
Rebecca, thanks very much indeed.
Thank you so much.
Rebecca Teltscher has been our guest.